Portfolio Construction and Risk Management. Chapter 5, Correlation and Market Relationships. Section 1, Correlation Basics. Correlation tells you whether two assets tend to move together, move in opposite directions, or move with no clear pattern at all. In investing, we usually calculate it from returns rather than raw price levels, because returns put different assets on a comparable basis. A $20 stock and a $2,007 stock can have very similar return behavior even though their prices look completely different. This matters because portfolio risk depends partly on how holdings interact, not just on how risky each one is alone. If two positions often rise and fall together, they may add less diversification than you expect. If they move differently, they may help smooth overall portfolio results. The correlation scale runs from -1 to +1. A value of +1 means two assets move together perfectly, while -1 means they move in exact opposite directions. A value near zero means there is no consistent linear relationship in their returns. That does not mean the assets are totally unrelated in every sense. It only means their return pattern does not line up in a stable straight line way. In real markets, most asset pairs fall somewhere between the extremes. That makes the scale useful because it gives us a common language for comparing relationships across sectors, asset classes, and strategies. When you read correlation in markets, you are really asking what forces are driving two assets at the same time. A high positive correlation often suggests they respond to similar economic conditions, investor sentiment, or industry trends. Negative correlation usually means they tend to benefit from different environments, which is why some combinations can help diversify risk. A correlation near zero suggests a weak linear link, so one asset's move tells you relatively little about the other's move. For portfolio construction, low correlation is often attractive because it can reduce the chance that everything moves in lockstep. Still, the economic story behind the relationship matters just as much as the number itself. Correlation is closely related to covariance, but correlation is usually easier to work with. Covariance tells you whether two assets tend to move in the same direction or in opposite directions, but its size depends on the scale and volatility of the assets involved. That makes raw covariance harder to compare across different pairs of assets. Correlation solves that by standardizing covariance using each asset's standard deviation. The result is always bounded between -1 and +1. Because of that standardization, correlation gives a more intuitive and comparable picture of co-movement. To calculate correlation, you start with matched return data for both assets over the same dates. Once those returns are lined up, you measure their covariance to see whether they tend to rise and fall together. Then you calculate the standard deviation of each asset's returns, which tells you how much each one moves on its own. Correlation is the covariance divided by the product of those two standard deviations. That division is what turns a raw relationship into a standardized measure. The formula may look technical, but the intuition is simple. How much do these assets move together after adjusting for how volatile each one is individually? In practice, investors often group correlation into rough ranges so the number is easier to interpret. Values between about -0.02 and +0.2 are often treated as weak or near zero. Positive readings around 0.225 suggest a moderate relationship, while values near 0.5 suggest a moderate relationship, while values near 0.5 suggest a strong. The same logic applies on the negative side, where more negative values imply stronger opposite movement. These categories are only rough guides, not hard rules. A correlation of 0.4 could be very important in one portfolio and much less important in another, depending on the size of the position, the volatility of the assets, and the investor's objectives. This example compares monthly returns for a technology sector ETF and a utilities sector ETF over 12 months. The estimated correlation is about -0.04, which is extremely close to zero. Even though the covariance is slightly negative, the overall result suggests almost no consistent linear relationship in this sample. Technology was much more volatile, with a standard deviation around 5.1%, while utilities were steadier at about 1.6%. So these sectors did not reliably rise or fall together during the period we measured. The key lesson is that a near zero estimate can appear even between two well-known equity sectors. when their short-term return patterns do not line up in a stable way. Near zero correlation matters because it may point to a useful diversification opportunity. If two assets are not moving in lockstep, combining them can reduce concentration in one single market pattern. That does not guarantee lower losses in every period, but it can help smooth the ride over time. The caution is that low correlation is a historical observation, not a promise about the future. During market shocks, assets that once moved differently can suddenly start falling together. So a low past correlation is helpful information, but it should be treated as conditional rather than permanent. It is important not to confuse correlation with causation. If two assets have moved together historically, that does not prove that one caused the other to move. They may both be responding to a shared driver such as interest rates, inflation, growth expectations, or broad investor sentiment. Some relationships are temporary and fade when the environment changes. Others may simply be coincidental over a limited sample. That is why correlation is best used as evidence of a pattern, not proof of a mechanism. Correlation is useful, but it has clear limits and investors often misuse it. With too little data, the estimate can be noisy and misleading. The result can also change a lot depending on the time period you choose, especially if one market regime is very different from another. Correlation can shift over time, and a single average number can hide those shifts. It also misses nonlinear relationships, so two assets might be connected in ways a simple linear statistic does not capture. In practice, correlation works best when combined with rolling analysis, stress testing, and other risk measures rather than treated as a complete answer by itself. This practice exercise pulls the pieces together by asking you to compute correlation from a very small price sample. The first step is to convert the 5 daily prices for each stock into 4 daily returns, because returns are what we compare. From there, you match the return pairs by date and calculate their covariance. Then you compute each stock's standard deviation and divide the covariance by those two volatility measures. Once you have the final number, the last step is interpretation. Is the relationship positive, negative, or near zero? Just as important, with only a few days of data, you should already be thinking about why such a short sample may not say much about the future. Section 2. Correlation shifts. Correlation is not a permanent trait of two assets. It can change as markets change. A shift may show up as a stronger relationship, a weaker one, or even a reversal from positive to negative. That matters because portfolio decisions are usually based on the assumption that past relationships still roughly hold. When the environment changes, that assumption can break down. An asset pair that once diversified each other may stop doing that. So the real question for investors is not just what the correlation was, but whether it is staying stable or moving into a new regime. Correlation shifts matter because many portfolio models rely on trailing historical data. If those old relationships no longer describe the present market, your risk estimates can become stale very quickly. Rebalancing rules that once made sense may need review, and risk budgets can drift away from their intended levels. This becomes especially important during stress periods, when correlations often rise across assets. That means diversification can weaken right when investors need it most. In other words, a portfolio can look balanced on paper while becoming much more exposed in practice. Stocks and bonds are one of the most familiar examples of shifting correlation. In many risk-off periods, stock prices fall while high-quality bonds hold up or rise, which creates a useful negative relationship. That is one reason mixed stock-bond portfolios have often been more stable than all equity portfolios. But this pattern is not universal. During inflation shocks, both stocks and bonds can come under pressure at the same time because higher rates hurt bond prices and can also weigh on equity valuations and earnings expectations. So the same asset pair can move from being a diversifier to moving in the same direction, depending on the macro environment. Correlation shifts are usually triggered by a change in the forces driving returns. Inflation expectations can rise, central banks can change policy, or a crash can create a sudden liquidity shock. Structural changes in the economy or in a specific industry can also alter how assets respond to the same news. Sometimes the shift is gradual, as one macro theme slowly becomes more important. At other times, it is abrupt, especially in a crisis. The common thread is that a new dominant driver begins to affect both assets, more strongly than before. A practical way to monitor correlation is to compare a baseline estimate with a rolling update. The baseline gives you a sense of what normal looks like, while the rolling window shows whether the current relationship is drifting away from that norm. Brief spikes happen all the time, so it is usually better to look for persistence rather than react to every short-lived move. The choice of window length matters too. Short windows respond quickly but can be noisy, while longer windows are steadier but slower to detect change. The best setup depends on how often the portfolio is reviewed and how quickly the exposures can realistically be adjusted. One simple way to measure a correlation shift is to subtract the baseline correlation from the current one. If an asset pair moves from -0.2 to positive 0.5, the shift is positive 0.7, which is a large change. That single calculation helps translate a vague sense of instability into something measurable. A bigger shift suggests the assets may behave very differently in the portfolio than they did before. It does not automatically mean you should trade, but it does mean the old diversification assumption deserves scrutiny. From there, the logical next step is to reassess variance, scenario behavior, and downside risk. This 60-40 example shows that diversification can weaken even when the asset allocation stays exactly the same. Initially, the stock-bond correlation was around -0.4, which meant bonds were acting as a meaningful hedge. Over the following 90 days, that relationship rose to positive 0.3. The shift of positive 0.3 is large enough to materially change how the portfolio behaves. Stocks and bonds were still both present, but bonds were no longer providing the same protection. That is a useful reminder that diversification depends on relationships, not just on holding more than one asset class. When a correlation shift appears persistent, the first response should be review rather than reflex. Start by recalculating portfolio variance using the new relationship, because the risk estimate may have changed more than the weights suggest. Then update stress tests to see how the portfolio behaves if the new pattern continues. Depending on the situation, an investor might reduce bond duration, lower overall risk, or add assets with different sensitivities. But the key idea is not to trade automatically on one number. The goal is to decide whether the shift is durable enough to matter for the portfolio's actual risk profile. This exercise highlights an important point. Higher correlation usually raises portfolio variance because the assets are offsetting each other less. Here, the final 60-day correlation increased to positive 0.65, well above the average rolling level of positive 0.15. That shift of positive 0.50 signals that the assets were moving together much more than usual. Even if the updated variance of 0.00 says manageable compared with some separate baseline, the diversification benefit clearly weakened. The covariance term in the portfolio risk calculation became more important. So the lesson is not just that variance changed, but why it changed. Several common mistakes make correlation shifts harder to interpret correctly. One is assuming that historical correlation is stable and therefore safe to plug into models without question. Another is treating a brief spike as if it proves a lasting regime change. Investors also sometimes ignore volatility regimes, even though calm and stressed markets can produce very different relationships. Shared macro drivers can be overlooked as well, which makes the shift seem mysterious when it is actually explainable. Good practice is to treat correlation as a moving input, monitor it, compare it with context, and update decisions only when the evidence is durable. Section 3. Cross-asset behavior. Cross-asset behavior looks beyond one market and asks how major asset classes interact. Instead of focusing only on stocks or only on bonds, it compares stocks, bonds, commodities, currencies, and real estate as part of one broader system. These markets often connect through common forces such as interest rates, inflation, economic growth, and investor risk appetite. When those forces change, several asset classes can respond together. That is why cross-asset analysis is useful for understanding when diversification is likely to help and when it may disappoint. It gives investors a wider lens on how portfolio risks can cluster across markets. A classic cross-asset relationship is the tendency for stocks and government bonds to offset each other during growth slowdowns. If growth weakens, corporate earnings expectations often fall, which can pressure stock prices. At the same time, investors may begin to expect central bank rate cuts or lower yields. Falling yields generally support bond prices, especially for high-quality government bonds. That creates a pattern where one side of the portfolio softens the blow from the other. It is one of the main reasons balanced portfolios have often shown lower volatility than equity-only portfolios. That stock-bond relationship can break down when the macro backdrop changes, especially during inflation shocks. In a stagflation-like environment, inflation remains high while growth weakens, and that can hurt both asset classes at once. Bonds may fall because higher inflation pushes yields upward. Stocks may struggle because rising costs, tighter policy, and weaker demand all weigh on valuations and profits. In that setting, the usual diversification benefit from bonds can shrink or disappear. So the relationship between major asset classes is conditional on the regime, not fixed by definition. Cross-asset behavior also shows up in the links between commodities and currencies. When prices for oil, metals, or other exports rise, producer country currencies may strengthen because their trade position improves. By contrast, countries that import those commodities can face higher input costs and pressure on their currencies. These relationships often reflect terms of trade, export dependence, and the broader growth outlook. They are common patterns, but they are not universal rules. Policy choices, capital flows, and local conditions can all complicate the picture. Risk-on and risk-off regimes are another useful way to understand cross-asset behavior. In risk-on periods, investors are more willing to take market risk, so equities, high-yield bonds, and some commodities may rise together. In risk-off periods, fear increases and money often moves towards safer assets such as government bonds, cash-like instruments, or sometimes gold. These shifts can happen quickly when unexpected news hits. As market mood becomes more dominant, correlations across several assets can tighten. That is why regime awareness matters for both tactical positioning and risk control. A practical cross-asset process starts by identifying the main driver of the current environment. Is the market focused on growth, inflation, policy, or financial stress? Once that is clear, compare current behavior with how similar periods looked in the past. Then watch regime signals such as equities, credit spreads, and the performance of safe haven assets to see whether the story is consistent. Finally, check whether the key correlations still fit the usual pattern or are beginning to shift. This framework does not produce certainty, but it helps investors organize evidence instead of reacting to isolated moves. When correlations change across asset classes, portfolio adjustments should be thoughtful rather than impulsive. If several holdings become more correlated, diversification becomes weaker even if the portfolio still looks balanced by asset count. In that case, it may make sense to reduce concentration in exposures that are all responding to the same macro force. You might also look for assets that behave differently in the current regime, rather than relying on yesterday's diversifiers. At the same time, caution is important because some relationship changes are temporary. The goal is to respond to a genuine shift without overreacting to short-term noise. The year 2022 is a strong reminder that regime matters. Inflation became the dominant driver, and the Federal Reserve raised rates aggressively in response. That combination hurt both stocks and government bonds, reversing the pattern many investors had come to expect. As a result, a traditional 60-40 portfolio lost more than 16%, which surprised people who assumed bonds would provide their usual cushion. Meanwhile, commodities and short-term inflation-linked bonds held up better. The deeper lesson is that asset relationships can change dramatically when the macro driver changes. The main takeaway from cross-asset analysis is that relationships should be treated as conditional, not permanent. Different asset classes do not automatically deliver true diversification if they are all being driven by the same force. Inflation, in particular, can reshape the stock-bond relationship and change how a portfolio behaves. That is why it helps to keep asking a simple question: what is driving markets right now? If the answer changes, the expected behavior of the portfolio may change with it. A good portfolio check is not just about what you own, but about why those assets are likely to interact the way you expect. Section 4. Market contagion. Market contagion refers to financial stress spreading beyond its original source. A problem may begin in one institution, one asset class, or one region, but then losses and fear spill into other markets that were not the initial trigger. This spread is often driven by forced selling, funding pressure, and investor panic rather than by normal economic links alone. That is what makes contagion different from ordinary co-movement. The damage extends further and faster than fundamentals would suggest. For investors, contagion is important because it can turn a localized shock into a broad portfolio problem. Ordinary correlation describes how assets typically move together over time in normal conditions. Contagion shows up when those relationships change suddenly during a crisis. Assets that usually have only a mild connection can begin moving together much more tightly, often on the downside. In those moments, fear and forced selling may matter more than valuation or macro fundamentals. So contagion is not just about high correlation. It is about an abrupt shift in behavior under stress. That is why crisis periods often produce portfolio outcomes that look very different from what calm period data would predict. A contagion episode often follows a recognizable chain. It starts with a trigger event that hits one market or institution first. Investors exposed to that area take losses, and some need to sell other holdings to raise cash. Those secondary sales push down prices in markets that were not the original source of the problem. As more assets start falling, fear spreads and correlations jump. What began as a localized shock can quickly become a system-wide stress event. Contagion usually begins with a severe event that damages confidence or weakens balance sheets. A bank failure or bank run can create immediate fear about funding and solvency. A sovereign default or debt crisis can force investors to reprice credit risk across a wider set of markets. A broken currency peg can generate sudden foreign exchange losses and undermine policy credibility. A sharp commodity price collapse can pressure exporters, lenders, and related borrowers all at once. Different triggers start in different places, but they all create the conditions for stress to spread. Although crises can look chaotic, contagion often travels through a few main transmission channels. The first is direct exposure, where investors or institutions actually hold the troubled asset and suffer losses immediately. The second is a liquidity spiral, where falling prices lead to margin calls or redemptions, which force more selling and push prices down further. The third is an information cascade, where investors infer hidden risks from observed selling and begin reducing exposure preemptively. These channels can reinforce one another. A direct loss can trigger forced selling, and that selling can trigger fear in markets that were only indirectly connected. Direct exposure and liquidity spirals are two of the most important ways contagion spreads. With direct exposure, losses hit balance sheets right away, reducing capital and often making institutions less willing or able to lend or take risk. Liquidity spirals work differently. Investors who need cash quickly may sell the most liquid assets they own, even if those assets are fundamentally sound. That selling pushes prices lower, widens spreads, and creates new losses elsewhere. As collateral pressure grows, more forced selling can follow, creating a self-reinforcing loop. Information cascades happen when investors act before they have complete information. If they see heavy selling in one market, they may assume similar assets or institutions face hidden problems too. That can lead to preemptive selling across a wider group of holdings. Prices may then fall faster than fundamentals alone would justify. In that sense, fear can become a transmission mechanism of its own. Under uncertainty, reducing risk can be rational for individual investors, even though the collective effect amplifies the crisis. Not every broad sell-off is contagion, and that distinction matters. Sometimes assets fall together because they share real economic exposure to the same shock. For example, if oil prices collapse, energy exporters, commodity currencies, and related equities may all weaken for understandable fundamental reasons. Contagion, by contrast, reflects stress spreading through forced selling, fear, or funding pressure into assets that are less directly linked. In practice, both forces can appear at the same time. The key question is whether the broader move is mainly telling you that fundamentals worsened or that the market is transmitting stress beyond those fundamentals. Contagion matters for portfolios because it can undermine diversification very quickly. Assets that normally offset each other may fall together when stress rises and liquidity becomes scarce. That means historical correlations can become unreliable just when downside protection is needed most. Defensive assets may still help over a full cycle, but in the middle of a crisis they may cushion losses less than expected. This is one reason stress testing is so valuable. It allows investors to ask not only what happens in normal times, but also what happens if correlations break down in panic. March 2020 is a clear example of contagion in action. The shock first hit travel-linked sectors tied directly to the pandemic, but stress quickly spread far beyond them. As volatility surged, some investors faced margin calls and needed cash. To raise that cash, they sold liquid assets, including U.S. pardon, treasuries, and gold, even though those are often viewed as diversifiers or safe havens. For a time, liquidity needs overwhelmed the normal relationships investors expected. That episode shows how a scramble for cash can spread pressure across markets that should not all react the same way. This exercise makes the arithmetic simple so the pattern stands out clearly. A $1 million position in U.S. equities losing 8% means an $80,000 loss. A $1 million position in emerging market government bonds losing 15% means a $150,000 loss, and gold down 5% adds another $50,000. The total portfolio loss is $280,000. More important than the total is the mix of losses across assets that do not usually all fall together for the same reason. Gold being down as well points toward a liquidity spiral, where investors were selling what they could to raise cash. The practical warning sign is not simply that prices are falling, but that many different assets are falling together when they normally would not. In those moments, do not assume diversification is working just because the portfolio holds several asset classes. It is also important not to label every synchronized sell-off as contagion without asking whether a real economic link explains it. Watch for signs such as margin calls, fund redemptions, and funding stress, because those often signal forced selling. Correlation spikes during crises should be treated as warning signals, not as permanent new laws of the market. Good risk management tests portfolios for both calm periods and panic periods. Section 5. Portfolio Interactions. Portfolio risk comes from interaction, not just from the individual risk of each holding. If you own several assets, the result is not a simple average of their standalone volatilities. Each asset's weight matters because larger positions affect the portfolio more. Each asset's own volatility matters because some holdings are naturally more unstable than others. But correlation is what tells you whether those risks reinforce each other or partly cancel out. That is why two portfolios with the same holdings can behave very differently if the weights or relationships differ. In a two-asset portfolio, diversification shows up in the interaction term of the variance formula. The first parts of the formula capture each asset's weighted standalone risk. The cross term adds in the effect of how the two assets move together, using their weights, volatilities, and correlation. If correlation is high and positive, that interaction term adds more to total risk. If correlation is low, the term becomes smaller. If correlation is negative, the interaction can offset risk and reduce portfolio variance more meaningfully. Correlation is one of the main levers that determines how much diversification a portfolio can actually deliver. At positive 1, two assets move together perfectly, so there is little or no diversification benefit. Between 0 and positive 1, some benefit remains because the assets do not move in complete lockstep. At 0, there is no consistent linear relationship, which can still be useful for diversification. Negative correlation is stronger because one asset tends to offset the other more directly. In the special two-asset case of negative 1, a particular mix can theoretically approach 0 variance, though that is an idealized textbook example rather than a normal market condition. Owning many holdings does not automatically mean a portfolio is well diversified. What matters is whether the holdings represent meaningfully different sources of risk. A large portfolio creates many pairwise interactions, and if most of those assets are highly correlated, the portfolio can still be heavily exposed to one common market factor. This is why a basket of similar growth stocks may feel diversified by count while remaining concentrated in behavior. True diversification depends on relationship structure, not on the number of line items. In practice, investors should ask whether their holdings are genuinely different or just different labels on similar risks. Expected return and portfolio risk are built in very different ways. Expected return is relatively straightforward. It is the weighted average of the expected returns of the holdings. Portfolio variance is more complex because it includes not only each asset's own volatility, but also the covariance terms that link assets to one another. In a multi-asset setting, that full structure is often written as W prime sigma W. So return is mostly arithmetic on weights, while risk is about both weights and interactions. That difference is why building a diversified portfolio requires more than just estimating which assets have attractive returns. This worked example shows how negative correlation can lower portfolio volatility below the volatility of either fund alone. Fund A has a 60% weight and 18% volatility, while Fund B has a 40% weight and 12% volatility. Their correlation is negative 0.20, which means their returns partly offset each other instead of reinforcing one another. When combined, the portfolio volatility is about 10.9%. That is lower than both 18% and 12% individually, which is a powerful demonstration of diversification. The key is not that one fund is safe, but that the interaction between the two reduces total risk. In larger portfolios, some asset pairs matter much more than others. This 3-asset example shows that the XY pair contributes the most to variance, even though the portfolio also contains XZ and YZ interactions. That happens because pair contribution depends on 3 things at once: the weights of the assets, their standalone volatilities, and their correlation. If 2 assets are both heavily weighted, fairly volatile, and positively correlated, their interaction can dominate the risk picture. The overall portfolio volatility here is about 31%, but understanding which pair drives that number is more useful than looking at the headline alone. It helps identify where diversification is weak and where risk is clustering. Naive diversification and optimization both spread money across assets, but they do not use information in the same way. Naive diversification often means simple equal weighting, which is easy to apply and usually better than concentrating everything in one holding. But equal weighting can ignore major differences in volatility and correlation. Optimization tries to use expected return, volatility, and correlation together to build a portfolio that better matches a chosen objective, such as lower risk or better risk-adjusted return. The trade-off is that optimization depends heavily on the quality of its inputs. So the choice is often between simplicity and robustness on one side, and precision with estimation risk on the other. A portfolio that appears diversified today may behave very differently under stress because correlations change over time. In calm markets, holdings may move in different directions and provide meaningful offsetting behavior. In stressed markets, those same assets can start moving together, which weakens diversification when it is needed most. Static assumptions can therefore understate real risk. Rolling correlation estimates and stress tests help investors see how the interaction structure is evolving. If those relationships shift enough, rebalancing or a broader portfolio review may be appropriate. Many portfolio mistakes come from treating diversification as simpler and more permanent than it really is. One common error is assuming that diversification will always persist without checking whether correlations are changing. Another is ignoring covariance terms and focusing only on standalone asset volatilities. Investors also often rely too heavily on historical correlations, as if the past relationship must continue. Low correlation alone is not enough either, because a very volatile asset can still add substantial risk. Finally, expected return and risk are not built the same way, so confusing those mechanics can lead to poor portfolio decisions.